All right, let's talk Westports. You might have seen the headlines. Revenue shot up by a whopping 25% in the second quarter. But here's the thing, their profit didn't quite get the same memo. So we're going to dig in and figure out what's really going on behind these numbers. So here's the central question for the quarter. You've got this massive 25% revenue jump, but profit before tax? That only grew by 13%. So what's eating away at that extra income? That's the gap we're here to explain. Let's get into it. Okay, first up, let's just look at the headline figures. But we're going to do it the right way, by focusing on the numbers that come from their actual day-to-day port business. So if you strip out all the accounting noise, the core operational revenue landed at 607 million ringgit. That's a really solid 10% jump compared to last year. And it's mostly because they're simply handling more containers. Good, strong, simple growth. And that strength actually flowed right down the line. Profit before tax hit 301 million ringgit, which is up 13% year on year. So profits actually grew a little faster than revenue, which is a great sign. And finally, the bottom line, profit after tax grew by a healthy 14% to 232 million ringgit. So looking at the core business, it was a great quarter. Double-digit growth across the board. But that still doesn't answer our first question. Where did that huge 25% revenue number come from? Okay, so let's solve this little mystery. It's time to peel back the layers and find the real growth drivers. And here it is, the key difference. You've got the reported revenue at 691 million, but the operational revenue from actually running the port was 607 million. That 84 million ringgit gap, it's not cash from customers. It's what you could call paper revenue from the big construction project for their port expansion. Now, why do they do this? Well, it's because of a quirky little accounting rule called IC Interpretation 12. All you need to know is that it forces companies to recognize revenue for big construction projects as they happen. The main takeaway for us as investors, you have to look at the operational figures to see how the real business is doing. Now, here's the other side of the story, the part that put the squeeze on profits. On one hand, Westports did a fantastic job managing their operational costs. They actually went down by 2%. Brilliant. But look at the other bar. Finance costs, they absolutely exploded, jumping 127%. This is the headwind right here, and it's mostly the interest they're paying to finance that massive port expansion. And hey, don't just take my word for it. The company says it themselves right in the report. They said profit improved, but was mitigated or held back by an increase in operating expenses. And a big chunk of that is, you guessed it, those higher finance costs. All right, enough about the income statement. Let's look at the financial foundation of the company. How's the balance sheet looking? And what's in it for shareholders? If we take a quick look at their financial health, we see two things. First, their cash pile went down a bit, by about 85 million. But, and this is the important part, they also paid down 125 million ringgit in debt. So while they're spending on expansion, they're also actively managing their borrowings, which is a pretty smart move. And now for the news a lot of you have been waiting for, the dividend. Westports has declared an interim dividend of 9.93 cents per share. Now you'll get 7.94 cents of that in cold hard cash. The other 1.99 cents you have the option to reinvest back into company shares. All in all, that's about 338 million ringgit going back to shareholders. So that's the picture for Q2. But what about what's coming next? This is where the story gets really interesting because there are a couple of huge catalysts on the horizon. Okay, this right here is a game changer. The government has given the green light for a multi-year tariff hike. Phase 1 just kicked in on July 15th with about a 15% increase. Then comes another 10% hike in 2026 and a final 5% in 2027. This gives them a really clear, powerful runway for revenue growth for years to come. And remember those finance costs we talked about? Well, this is what they're paying for. The massive Westports Q2 expansion is officially underway. They've started the groundwork, which will take a few years. It's being funded by their own cash and a huge 5 billion ringgit program. The first new terminal should be up and running by 2028, setting them up for the next generation of growth. So let's pull all this together. If you're an investor, what are the key things you need to be looking for in the next quarterly report? Here are 3 things for your watch list. First, container volumes. Keep an eye on whether they can maintain that positive growth. Second, the big one, tariffs. The next quarter will be the first to include the new higher rates, so we'll see just how much extra cash that brings in. And third, finance costs. Was that 127% jump a one-off spike, or is this the new normal? So, to wrap up the quarter in a single snapshot, things look good. Operationally, revenue was up 10% from last year, and just as important, it was up 3% from the last quarter. That shows the momentum is still there. And that positive trend carried right through the bottom line, with profits also up quarter on quarter. It's a picture of steady, consistent improvement. And this really brings us to the final, most important question moving forward. You've got this powerful tailwind from higher tariffs pushing them forward. But you've also got this nagging headwind of rising costs pushing back. The big question for the next year is, can they use that tariff tailwind to power through the cost headwind and actually grow their profit margins? That's what we'll be watching. And that's all for this explainer. Just a reminder, this is for informational purposes only and definitely isn't investment advice. All the numbers came directly from Westports public reports. Thanks for tuning in.